Broadcasting from the Business RadioX studio in Orlando, Florida, it's time for Regions Business Radio Orlando. Regions Business Radio Orlando is presented by Regions Bank. Brave the beginning. Member FDIC.
Welcome to Regions Business Radio Orlando, presented by Regions Bank, member FDIC, and an equal housing lender. I'm your host, Scott Wall, and I'm a commercial banking leader with Regions Bank here in our Central Florida market. We are broadcasting live from the Business RadioX studio inside the Marriott Hotel in downtown Orlando, Florida. I have two guests today, and both of them are colleagues of mine within our residential mortgage lending team, Cindy Branch and Wendy Cummings. Welcome to our podcast, ladies.
Thank you. Happy to be here.
So you both have been with the bank just a couple years, right? Can you maybe tell our listening audience how many years you've been with the bank and how many years in this industry?
I've been with Regions 23 years minus 2 weeks, and I've been in the industry way longer than I care to elaborate on.
I have been here 23 years plus 2 weeks. That's why Cindy has always said that, because I was hired first. Well, we might as well say we've both been here 23 years.
It's a long time.
It's always important, though. The distinction.
Seniority.
Yes.
Thanth for pointing that out, both of you.
Thank you.
In your careers, and let's go back 25 years, has it changed the business of making residential loans, generally speaking?
It's a roller coaster. When I got in it, interest rates were pretty much where they are today. It was a, W-2 wage environment. Fast forward to 2005, a whole different story. Stated income, no asset. Fast forward to today, definitely back to where it was, and a bit of a challenging environment. Cindy, what do you think?
Oh, I totally agree. When I got into it, rates were in the teens. And yeah, there's a bit of a difference as to a lot of parts and pieces that go into the process today. Nothing is left to speculation. Everything is documented and addressed, et cetera, where before, you could assume a few things. Today, not so much.
And we're going to delve into this specifically on some of these specific topics. But what you're describing, maybe the changes over the last, call it 25, 30 years, is regulation driving these changes at the heart of it? Maybe federal regulation?
Oh, I would say yes. No question. And the economy.
Yeah.
The 2008 downfall, so things were drawn back and then kind of released slowly, but we'll never be to that point again where there's so many financing options that are less conventional.
Right. I want to come back to that. Would you say, is it harder for someone to get a loan to buy a house now than it was in, let's say, 2008, 2009, I guess around that period? Is it more difficult now?
Actually, we've loosened up a bit from that period of time. From when 2008, when it all imploded, at that point, we were having to get profit and losses and balance sheets on self-employed borrowers almost up to the day of closing. So if, say, for example, today we're in 2023 and you still have your 2022 tax return extended,
Yep.
We needed P&Ls. We needed P&Ls all the way through September of 23.
P&L, profit loss statement.
Sorry,
right? Yep.
profit and loss.
Yep.
We do not today. We have loosened up in that regard. We only need your tax returns that you have filed. So that is probably the best thing, but we still, to this day, trust but verify. Trust but verify. So it's challenging, but it's not 2007.
And I would agree, if you have good income, good credit, and some funds, not necessarily as much as you may think, but some funds, you can certainly buy a house today.
So someone can buy a house. That's
question whatsoever.
Okay. Cindy, you made a comment about interest rates, and you were quipping about when you started, rates were in the teens, but they're a lot higher now than they were 18 months ago. In fact, last I heard, the 30-year conventional interest rate was over 7%, right?
Yes.
And so 18 months ago, maybe even 14 months ago, it was, it was like 2.5%, 3%. Discuss that. How is that impacting a potential home buyer now?
Well, I just recently read an article, and it's true. I can attest to, as can Cindy, that today's 30-year payment is $400 more a month. On the average $300,000 mortgage, $250 mortgage, is $400 more a month than it was 18 months ago.
When you also address the impacts of the new homeowners insurance issue, all those things, and also affordability of homes today, All those issues are impacting the total payment.
What about, are there situations where someone's got a 3% rate and they might not want to sell their house because they know that their new rate's going to be closer to 7? Is that a dynamic that's happening right now?
Oh, of course. That is coming into play with regard to inventory. People don't want to give up their 3% to going. They know, first of all, the price is up. Secondly, the rate is up. So they're going from a 2 or 3 or even 4 to a potentially 7% rate. So I think there's a lot of consideration from that with regard to selling an existing home when you're going to have all those impacts.
So think about maybe someone out there that's listening that's a potential buyer, a house, a condo, a townhome. I'm going to cycle through, relate to maybe that example. Let's start with credit rating. Is it still a really big deal? And any considerations that someone should be thinking about when it comes to their credit rating and getting a mortgage application?
Credit rating has always been an important factor, and I wish they would teach more of this in school, in the elementary schools, the importance of your credit score. Credit score can make or break you from getting a loan approval or qualifying for a loan. In general, a jumbo loan, which is anything over
726 something.
726 to 726,200, you pretty much need a 700 credit score to get a jumbo loan. That being said, people really need to understand the importance of credit, and the credit bureaus, not the credit bureaus, the credit karmas out there are not giving accurate pictures of a client's credit score. They need to come to us and let us look at their credit. And then if their credit's not there, we can do credit score simulators that will help drive them on how to get there. Sometimes they try and do their own self-help, and they actually make it worse than they do, better. So it's important.
Are you suggesting that if I wanted to buy a house and I wanted to kind of gauge my credit, I might go online through some agency and find my credit, but when you pull my credit rating, it might be different? Is that what you're...
No question.
Okay.
Yeah, no question.
Okay.
The algorithms are different in what Credit Karma offers. There's so many different ones out there. We pull a FICO score. We pull a FICO score from all 3 repositories. We take not an average, a middle score of all 3. So basically what you pull from Credit Karma, oh gosh, we've seen them as much, I want to say 50, 80 points difference between what you're pulling and expecting that to be what I pull in regard to what I'm able to pull from my process.
Got it.
So it's very different, and that's why educating yourself with a lender before you try to go the self-help way is a much better idea.
Okay. All right. Good advice. I think a primary metric for an application would be debt to income, right? This is a ratio. Maybe speak a little bit about that. I think many of our listeners probably know what it is, but what is it and how has it changed over the last 15, 20 years with regards to a mortgage application?
Truly, debt to income is the total payment on the new property. Any auto loans, minimum on charge cards, not what you pay, but the minimum payment per a credit report on your charge cards. Student loans factor into that depending on a few different factors, and that into your gross monthly income is debt to income. So the total debt to income, the total debt into your gross monthly income is debt to income ratio. Gross numbers,
Gross
yes.
pay, okay. So if the loan I want, I'm using gross numbers, but I'm actually paying the loan in after-tax income, what's the disparity? Talk about that disparity. Because that could, maybe someone gets a bigger loan than they actually can afford. Is that a thing?
In 2005, that was definitely a thing. Today, it has always been, debt to income has always been based on gross income. So it is our job, and especially in our years of experience, to educate the client and make sure that they understand and can sleep at night. Here's another important factor. Property taxes can escalate if a seller has owned a property for 4, 5, 6, 10 years, homestead. Those taxes are going to go up dramatically next year. we educate our clients on that. So these are the things that having an experienced loan officer will help the client to make those sound decisions.
And so, Wendy, that means you might counsel someone, they might want to afford something a little less, right? Maybe they don't want to spend as much because of this dynamic that you're mentioning with property taxes. Okay.
And that's also why it's so important to talk to a lender before you start shopping. Because what we're going to show you as to your total cash out of pocket, your proposed payment, you're much more informed at that point than going out and buying that, wanting to buy that $750 house when your pocketbook only either qualifies you for $500, and or if you're only comfortable paying a certain amount, then we're going to back into what you should shop and what price range you should shop in, depending on your down payment. So there's so much knowledge that can be gained by starting with your lender and then begin shopping rather than doing it the other way around.
Got it. One more comment, Cindy, on the debt to income. What's the rate now? I feel like it was 36% at one point. What do we think it is now, give or take?
Wendy, I'm going to let you speak to that.
Well, it's 43% in general.
Okay.
The secondary market, Fannie Mae, Freddie Mac, FHA, they will allow a client to go to 50% debt to income.
Is that a newer requirement?
No, I mean, it's been around for a while. In 2008, it got scaled back to 42. I don't know, but
Okay.
It's definitely 43 in the jumbo market.
Okay.
The strength of the borrower. I think if you've got limited credit, limited down payment, et cetera, even those agencies may scale it back from 50. So all it's automated underwriting, and all those factors come into play. Down payment, credit score, debt to income, all those drive where the system will allow you to go to as far as a debt to income.
Okay. And speaking of down payment, let's talk about that. In today's environment, what might someone expect for down payment on a conventional mortgage application?
You can get away with as little as zero, but that is for our affordable housing product for first-time home buyers.
So that still exists?
Yes,
Okay.
It does exist. It does exist for physicians.
Yep.
So it's for first-time home buyers. And let me talk a little bit about down payment of first-time home buyers. You'll get a call from a first-time home buyer, and they'll say, what's out there for me? I'm a first-time home buyer. Well, all first-time homebuyer programs have income limits. So if you're making above the median income, 80% of the median income, you're not getting 100% financing. Jump to 3% down payment, you can get in with Fannie Mae with that. If you want to avoid PMI, private mortgage insurance, you need to put down 20%.
At least 20%.
At least
So if a
20%.
borrower puts down less, they're going to pay PMI.
Yes.
Okay.
Which
And
is
what
for
is
the
that?
lender's benefit.
What is that for?
Private mortgage insurance is insurance that protects the lender in case of a default on your part, since you don't have a minimum of 20% invested in the property.
Got it.
So you pay for it, but it protects the lender.
Got it. If someone was thinking about a mortgage, what are some rules of thumb? Like, how do you counsel people generally? And I'm sure every file is different. I get that. But one thing you did mention that I think is important is counseling early and often before, whether you're buying a house or you're refinancing a house. The advisory role you two ladies play is pretty significant, particularly for a first-time home buyer, right?
Yes, we can look at all your numbers. We can tell you, okay, if your limitation is cash to close, we can give you options there. If your limitations are debt to income, we can tell you how to get there from here. If your issues are credit report, we have a simulator. Once we pull credit, we can say, okay, you have options. This is how much you need to get your credit score where it needs to be. So truly, you gain so much knowledge by talking to a lender before you do anything.
Yeah.
Once you've started down that road, it's much more difficult to fix what issues you've thought you've fixed all along the way. Would you agree?
I couldn't say it better. I mean, that is beautifully put.
Well done. Thank you. What's more important, if either is still important in the process, a pre-qualification letter or a pre-approval letter?
Good research, Scott. Definitely pre-approval.
Pre-approval.
Yes,
Okay.
pre-qualification. Again, with our years of experience, almost 50 combined, we know the questions to interview. We know to say, oh, you've only been getting overtime for 6 months. we can't use that. You have to have overtime for 2 years. That's a pre-qualification. Pre-approval is you give me your pay stubs, you give us your asset statements, we put them before the underwriter, and you are vetted through underwriting, and you are truly approved for that loan, not just qualified as a verbal.
And if the housing market's tight, that gives a potential buyer power.
Yes.
Especially in what we have right now, which is a cash market.
Yes.
Yeah.
You know, the seller
Without a
said,
doubt.
gosh, I've got a cash deal. I've got a pre-qualified buyer. One seems like cash in hand. The other is still questionable, if you will.
And what about pitfalls, other pitfalls? One that maybe one of you two mentioned to me, Cindy, it might have been you, is like when you apply for a mortgage, no surprises with regards to applying for other debt concurrently, for instance, an installment loan for a car or whatever. Can you speak about that dynamic?
I thought it was funny when we introduced debt monitoring 5 years ago. I was indignant. I was like, why are we monitoring a client's debt? Now, today, it's like if I get a debt monitoring, I'm on the phone with that client going, why are you at Target opening a credit card? Oh, well, I need to get new towels for the house. No, you do not. You get nothing for that house until you get the keys to that house.
Yeah.
So yes, debt monitoring, we tell them, do not. And if you have another lender pull your credit, we'll know that too. Just saying.
Any other really important pitfalls?
I would say take guidance from your lender. It makes a big difference. You do something the way you think it should be done, may be the total opposite of the way it needs to be done to make the process can either be as easy as possible or as hard as possible. It depends on how you want to make it. If you follow the instructions on whether it's getting your credit score where it needs to be, it's a very precise process. Or a gift. There's certain ways to do it that make it easy. There's certain ways you can do it, which may make the steps we have to go through to verify that gift much more difficult. So there is a process to what we do. Follow your lender's advice, and we'll get you there with as little hoops as possible.
Got it.
No question there's hoops,
Yep.
but as little as possible.
And I got to tell you, the industry has got to catch up with the Zelle payments and the Venmo, because to this day, underwriters still want to see, where did those come from? Why did you get those? We're not at a point yet where we're accepting, oh, well, you just got a Zelle payment. So be prepared to give us those explanations too.
Well, and the explanation's also on liquidity, right? That's important. Proving out whatever cash or liquidity a borrower might have.
There's such thing as cash in our world.
Yeah.
We
Never
have to
has
verify
been.
you have the money. If the money just appeared in your account, I want to know where it came from.
Yeah.
So there's no cash exists in our world for the down payment, the closing costs, the prepaids. Oh, and that's something else we want to talk about. The cash to close is not only your necessary down payment, you've got closing cost and prepaids into the escrow account, which are your first year's homeowner's insurance and the money's necessary so that when your next tax bill and or homeowner's insurance bill comes in, we have enough money in that account to pay it. So that's what equals your cash to close: down payment, closing cost, and prepaid.
And the PMI insurance you spoke of is different under the lens of a prepaid as homeowners insurance, right? Like, would someone escrow taxes and homeowners insurance and then separately pay PMI?
It's all paid into the escrow account.
It is all in the
So
escrow?
it is, yes.
Okay.
Your payment consists of principal, interest, taxes, insurance, and mortgage insurance if applicable.
And oh, by the way, alongside inflation and interest rates, insurance to insure properties is up too, correct? This is a trend.
Homeowners insurance, the increase has become insane. And, the clients call. We've been here each 23 years. We have 23 years of past customers in our database.
Yep.
And they're calling us going, why did my mortgage payment go up? You told me it wouldn't. It was that insurance premium went up $2,000. So yes, it's a huge variable.
For either of you, is there a rule of thumb for closing costs within the state of Florida?
I mean, it depends. There is not a rule of thumb. It's not a percentage of your loan amount. It really depends on the loan size. So the lesser the size of the loan, the higher the percentage of the cost. So because a lot of costs are fixed.
title insurance, recording fees, preparation, appraisals, these are third-party fees, right?
Yes.
Okay.
And also in the state of Florida, our costs are higher than other states because the state of Florida does not have an income tax. So basically, the revenue the state obtains is from title insurance, doc stamps, et cetera. So our costs are higher than other states that have the income tax. So that's our revenue for the state.
Got it. Let me go back to the discussion we had on interest rates. This is a weird question. If whether I'm in Schenectady or San Luis Obispo or Orlando, Florida, and I'm the same borrower and I've got the same income, is the rate going to be the same in all these places? I mean, are interest rates uniform wherever I'm buying property?
Yes, with the exception of probably California and Hawaii, which I'm not familiar with what those rates are, but those states tend to be out of the realm of normal. But yes, you're going to get the same rates.
Same rate.
Fannie and Freddie are national.
Got it.
Secondary market.
I was thinking about this, ladies, before as I was preparing for it. Is it fair to say that oftentimes a house is a family's largest asset? So there is a part of what you both do. It's almost like an aspect of financial planning. And do families understand that and they get the consequences of that?
Well, the consequences, I don't know. The consequences are if you don't pay, truly. But basically, your home is part of your family's whole. I don't quite know how to say it, but it is it's comfort.
Yep.
It's where you go. So the process is very personal.
Very personal.
For every individual. Yes, I think it's your biggest asset. The amount of value that has gone up, even in the past just 2 or 3 years, is significant, probably as high as anything you can get as far as interest rates, et cetera. Mm-hmm. So, and it's it is the most important from the health of your family. And it's nice to come home to your home.
Sure. And I'm not asking for personal financial advice, but both you still, buying a home is a great investment long term, right? I mean, the economy goes up and down with rates, but it's still a great long term investment. Is that a
Absolutely. Rent is 100% interest.
Yeah.
So therefore, mortgage on your home, the home is yours. You're paying towards your principal and then some interest. But as a financial asset, 10% return is what we've been seeing year over year. Now, again, will that be forever? No. But you're not getting that return on your savings account. So yes, you are absolutely right. It is one of the biggest financial assets of a family's overall financial picture.
Got it. Got to ask you this too. Artificial intelligence, how is that playing into what you do at Regions Bank, if at all, during the process of taking an application or approving a loan or the back end?
Well, they said that artificial intelligence would be taking over our job 10 years ago. What is it they say? The rumors of the death of the loan officer have been greatly exaggerated.
No question.
We have a service that we send tax returns through to analyze self-employment income. How many times do we have to correct it?
All the time. It is crazy. Yes, the depth of knowledge for your loan officer is huge.
It's still big.
Yes.
And that's a human
no
touch.
Question.
Yes.
That is,
yeah.
And I think that's big in itself.
Yep.
Whether you're complicated, whether it's an easy transaction, the human, interaction is much more important than just going to somewhere where you're just a number. No one that we see is just a number.
Yeah, and AI is not going to see that. Now, I can't speak to 20, 30 years from now, but when Cindy and I are both retired sitting on an island somewhere, but yes.
And speaking of which, any stories that you would want to share with our listeners?
None that I can share out loud.
Okay. I'm sure you've helped many people.
And it's always a pleasure.
Yeah.
To get someone to the closing table and celebrate with them is always a pleasure.
And we have been blessed that these clients come back year after year. And we have been at the same employer each 23 years, which speaks volumes to Regions and our mortgage products. And our clients keep coming back because we offer these great mortgage products. So
that says something.
Yes. And we've worked for the same man.
Yes.
Ron Rawson for
question.
23 years. Got to put that in there.
He's a professional.
Yes, he is.
Is it fair to say you both love your jobs?
Yes.
Maybe not every day.
Love, hate sometimes.
Yes.
It's only when I get pages 1 through 3 of pages 1 through 4 of the bank statement. I need page 4, people. But yes, we love our job. We really do. I mean, it's an awesome job.
Really appreciate you both coming on today, and incredible careers within this industry, helping hundreds, if not thousands of people with that biggest asset. So thank you.
Thank you.
Thank you.
I'd like to thank our guests and our listeners to Regions Business Radio Orlando, presented by Regions Bank, member FDIC, and an equal housing lender. You can enjoy our episodes anytime by visiting businessradiox.com and selecting the Orlando studio, and then clicking on Regions Business Radio. This program is also available on iTunes, Spotify, iHeartRadio, or wherever you enjoy your favorite podcasts. Please be sure to subscribe to the program so you don't miss any of our future episodes. I'm Scott Wall, and you've been listening to Regions Business Radio Orlando on Business Radio X.
Regions Bank, member FDIC, equal housing lender. This information is general in nature and is not intended to be accounting, legal, tax, investment, or financial advice. Regions believes this information to be accurate when recorded, but it cannot ensure that it will remain up to date. Consult an appropriate professional concerning your specific situation. The information should not be construed as a recommendation of a specific course of action for any individual or business. All Regions products and services are subject to qualification requirements, terms, conditions, fees, and credit approval. Regions reminds its customers that they should be vigilant about fraud and security, and that they are responsible for taking action to protect their computer systems. Fraud prevention requires a continuous review of your policies and practices as the threat evolves daily. There is no guarantee that all fraudulent transactions will be prevented or that related financial losses will not occur. Visit regions.com/stop fraud or speak with your banker for further information on how you can prevent fraud.